The paper price of silver flashes $51 per ounce on the COMEX screens, but try securing a physical bar. Dealers demand $65 minimum, with delivery stretched to 6 weeks or more. That's a 27% premium disconnect, not seen since the 1980 squeeze, and it's widening daily. Overnight on December 12th, the CME Group jacked margin requirements on silver futures by 50%, from $12,000 to $18,000 per contract, aiming to choke the rally that hit $59 just hours before. Yet by morning, the price clawed back 8%, shorts bleeding another $400 million in unrealized losses. This isn't market correction, it's the machinery of control seizing up, exposed in real time. Banks like JPMorgan, once masters of spoofing billions in phantom orders, now hold positions underwater by $1.3 billion as of October. Their kill switch fired in desperation, and it misfired spectacularly. Watch how the fracture lines run deeper than one commodity. Silver isn't just industrial metal, it's the monetary system's silent alarm, suppressed for decades to mask the dollar's erosion. In a stable regime, paper derivatives mirror physical supply. Futures settle smoothly, premiums hover at 2 to 3%. Inventories flow without backlog. But here, global refineries report bottlenecks at 40% capacity utilization for deliverable bars, while Shanghai exchange logs weekly inflows topping 50 million ounces, the highest in 18 months. India alone imported 1,600 tons in November, draining Western vaults faster than mines can replenish. This divergence signals not demand spike alone, but a systemic unwind. The same elites who built the post-Bretton Woods order now pivot, leaving the paper edifice to crack. Consider the mechanics at play, the ones that echo across centuries. Back in 1694, William Patterson's Bank of England deal loaned £1.2 million to the Crown at 8% interest, birthing a debt-based currency that fueled empire. By 1815, British debt ballooned to £885 million, the pound sterling dominating global trade, until industrial output peaked mid-19th century. Costs outran revenues, and the same financiers shifted capital to America's railroads and steel mills. Rothschild funds poured in, building the next hegemon, while Britain clung to gold standard illusions until 1931's collapse. The pound lost 98% against gold thereafter. Holders of paper reserves watched value evaporate. Fast forward to Weimar Germany, 1923. Reichsbank monetized reparations debt, money supply exploding from 8.6 billion marks in May to 400 quintillion by November. Hyperinflation wiped the middle class, but it served a purpose, erasing internal war bonds, paving way for American credits via the Dawes Plan. U.S. banks restructured, gained influence, then withdrew before the 1930s crash enabled worse chaos. These aren't isolated failures, they're stages in a repeatable cycle. Stage 1. Elites monopolize money creation through a central bank. Stage 2. Debt finances expansion. Wars, welfare, dominance. Economy booms, confidence peaks. Stage 3. Overextension hits, currency debases, cracks appear in asset pricing. Stage 4. Architects transfer wealth to the rising power before total breakdown, leaving the masses with devalued fiat. We've seen it with the dollar since 1913's Federal Reserve Act. Bretton Woods pegged it to gold at $35 per ounce in 1944. Reserves in Fort Knox backing global trust. 2 decades of growth followed, but Vietnam, Great Society programs, and Cold War arms races demanded more dollars than gold could cover. By 1971, foreign banks like France and Britain demanded physical redemption. Switzerland exited the system. August 9th, Britain requested $3 billion in gold transfer. August 11th, Nixon closed the gold window. August 15th, reserves down to 10,000 tons. Temporary suspension persists. Dollar lost 98% versus gold, since from $35 to over $3,000 today. Apply this lens to silver now, and the anomalies snap into focus. Silver's paper market, dominated by futures on CME and LBMA, has long been the dollar's pressure valve. Suppressed prices hide inflation's bite. But in 2025, physical demand shattered the illusion. Solar panels alone consume 200 million ounces annually, up 35% from 2024, while AI data centers spike electronics use by another 50 million. Total deficit hits 300 million ounces, per UBS estimates. Yet paper shorts persist at 43,000 contracts among top bullion banks. JPMorgan fined $920 million in 2020 for 7 years of spoofing. Placing fake orders to drive prices down, canceling before execution, shifted tactics. By mid-2025, they flipped from massive shorts to net long, reportedly holding 750 million ounces in vaults, a pivot that screams Stage 4 preparation. Why? Because physical scarcity forces it. Lease rates spiked to 40% in October, signaling no one's lending bars anymore. Backwardation grips futures. Near-term contracts trade at premiums to later ones, inverting the curve as holders refuse to part with metal. This isn't hype, it's the logic of depletion. In a healthy system, supply responds to price signals. Mines ramp up, recycling surges. But silver output peaked at 900 million ounces globally in 2024, flatlining despite $50+ prices, as primary mines dwindle and byproduct from copper/lead operations can't scale fast. Meanwhile, institutional flows tell the transfer story. BlackRock's iShares Silver Trust, SLV, saw inflows eclipse 2024 totals by July, locking up 500 million ounces off-market. Pensions and sovereign funds follow, but quietly. Chinese state entities hoard via Shanghai, amassing reserves that rival Fort Knox's gold. Recall 2018 to 2020. Amid US-China trade war bluster, Wall Street pumped $1.4 trillion into Chinese markets, MSCI indexing forcing passive billions eastward. Same here. Silver flows east as Western paper unravels. If you've tracked commodity flows or run numbers on exchange inventories, share what you're seeing in the comments. Does this eastward drain match your data or point to something sharper? The silence from regulators amplifies the signal. CFTC probes London's fix for manipulation whispers, but no action as prices detach. Media tiptoes around it, framing as volatility, while Hal Turner reports the margin hike as desperate theater. No headlines on how this echoes Nixon's 1971 shock, when gold window closure masked overprinted dollars. Back then, silver followed, demonetized in 1965's Coinage Act, shifting to fiat fully. Now, its resurgence exposes the dollar's 98% debasement. $35 gold in 1971 equates to silver at $2. Today's $3,000 gold implies silver north of $170 if ratios hold historical averages around 17 to 1. Yet paper caps it at $51? That's the fracture. Ratios blew to 60 to 1, unsustainable in deficit reality. Push further into the interlinks. Geopolitics weaves through logistics like veins in ore. China's resource war escalates. While West touts Samsung's battery tech, Beijing secures silver for EV dominance, importing volumes that starve US fabs. Military angle sharpens it. Hypersonics, drones, radar all guzzle silver, with Pentagon stockpiles reportedly down 40% since 2022 Ukraine aid drains. Add tariffs. Silver added to US critical minerals, list September 2025. Potential 50% import duties looming. Yet enforcement lags as physical already commands premiums. This isn't growth, it's rupture. Supply chains buckling under deficit, while paper pretends abundance. Historical mirrors reflect the breakage point. Britain's empire peaked when industrial share slipped below Germany and US. Debt-financed Navy couldn't sustain. Similarly, US debt to GDP at 98% today. Fed balance sheet still over $7 trillion post-pandemic bloat from $1 trillion in 2008. Monetization fuels it. Deficits top $2 trillion yearly. Money supply outpacing GDP by 15% annually. Silver's squeeze? Early warning of stage 3 bleed into 4. Banks don't flip long without seeing the end. JPMorgan's 2025 position shift mirrors Rothschild's funding US expansion as Britain faded. Weimar's deliberate inflation cleared debts, but invited foreign restructure. Here, silver's physical lockup by institutions positions for dollar reset. What strikes you about these parallels? Do the numbers on debt monetization align with what you've modeled for commodities? Drop your take in the comments, especially if you're in finance or tracking reserves. The non-linearity hits here. Consequences precede full causes in perception. Premiums soared before margin hike. Eastward hoarding predated public deficit admissions. Flip cause effect. Industrial boom drives demand, but suppression bred the backlog. Decades of low prices discouraged mining investment, creating artificial scarcity now exploding. In 1923, Ruhr occupation sparked Weimar printing. Today, solar/AI surge sparks silver drain, but underlying is fiat overextension. Numbers drive the indictment. Global silver mine supply, 830 million ounces projected 2025, down 2% from 2024. Demand, 1.2 billion ounces per Silver Institute. Deficit widened to 370 million after recycling. Physical investment, 182 million ounces in bars, sha, coins, lowest since 2020. Yet premiums persist, signaling not weak retail but institutional vacuuming. ETFs hold 800 million ounces, up 20% YTD. But redemptions lag creations. Metal stays locked. COMEX deliveries record 150 million ounces, Q3 2025. Yet eligible stocks dip below 100 million, forcing reclassifications from registered to eligible just to meet calls. That's not liquidity, it's sleight of hand. Geopolitics amplifies. Russia's 2025 silver export curbs, citing defense needs, cut 50 million ounces from market. India's tariffs on refined silver hiked to 15%, yet imports surge. Contradiction? No, it's hedging rupee debasement amid 7% inflation. China. Shanghai vaults at capacity, premiums hitting 15% over spot. This transfer mirrors materials core. While Washington postures on decoupling, capital flows east. BlackRock, JPMorgan expand in China. 2020 peak trade war saw 1.4 trillion US portfolio investment there. MSCI weighting China to 43% in emerging indices. Silver follows. Eastern demand pulls physical. Western paper shorts cover at loss. If you're in supply chain or metals trading, how does this physical tightness show in your operations? Share observations in comments to map the ground truth. The behavioral signals from players seal it. Hedge funds slash silver shorts by 30% since September, per CFTC data. Yet banks like HSBC, UBS linger exposed. Deutsche Bank's $267 million 2015 spoofing fine? Precursor. 2025 sees similar probes, but scale dwarfs. Miners lag. Silver stocks up only 15%, versus metals 100%, YTD. Disconnect screaming undervaluation. Profits at record. Pan American Silver reports margins over 60% at $50 per ounce. Yet multiples compress. When institutions rotate, re-rating crushes shorts. Invert the narrative. Suppression worked when physical was abundant. Vaults overflowed post-2011 slam. Diamond era. Now, deficit inverts power. Buyers dictate. Margin hike aimed to liquidate longs, but rebound proves failure. Leverage kill switch activated, yet physical holders unmoved. 1 ounce remains 1. Paper claims multiply, but delivery fails. This echoes 1971 gold demands. De Gaulle's warship, Britain's transfer request, forcing Nixon's hand. Today, Eastern calls on silver force banks pivot. What interpretation fits your view of these delivery failures? Closer to deliberate unwind or unintended snap? Weigh in comments with your logic. The loss of control cascades. Logistics jam. Shipping delays from Red Sea disruptions add 20% to transport costs, bottlenecking metal flow. Military draw. US added silver to critical list, yet no stockpiling boost. Depletion accelerates. History shows why now. Earlier cycles had buffers. Britain's colonies, Weimar's coal. Dollars buffer, petrodollar, but Saudis. June 2024 non-renewal of 1974 agreement erodes it. UN trades rise 300% in oil. Figures underscore. US debt $36 trillion. Interest payments eclipse defense budget at $1.2 trillion annually. Fed's QT reversed. Balance swells anew. Silver's 2025 surge. From $29 January to $59 December peak, before correction that wasn't. Backwardation depth. Front month premium, 5% over 6 month. Unseen since 1980. Hunt squeeze. Then, price hit $50 before rules changed. Margins hiked, exchange intervened. Sound familiar? 2025's overnight rule tweak, but unlike 1980, physical deficit prevents full suppression. Interweave industry. Solar demand projected 250 million ounces, 2026, up 25%. But panels require high purity. Refineries can't pivot fast from recycled scrap. Biology tie in. Silver's antimicrobial use in medtech surges 15%, but minor. Finance. Polygon data shows silver volatility index at 45. Double golds. Not random, but fracture. Crypto parallel. Banks sell assets like Bitcoin to cover shorts, per post. December 2025 crypto dip aligns with silver contract expiries. If you've spotted similar cross-asset bleeds in your portfolio or analysis, note it in comments. Helps trace the web. The pattern's math is inexorable. Debt-based system expands until productivity decouples from money growth. US M2 up 25% since 2020. GDP 15%. Gap inflates assets, but silver's tangibility exposes. Stage 3. Visible rifts, like physical paper split. Stage 4. Transfer. Institutions to physical, capital to east. Wall Street's China bets during 2018 tariffs. Prototype. 1.4 trillion flowed as Trump levied $34 billion duties. Non-linear reveal. Symptoms first. Premiums, then cause. Deficit data emerges. Politics distracts. Think tanks debate decoupling. Media on trade wars. But flows continue. Britain's populace missed capital to US. Germans overlooked US banks in hyperinflation setup. Americans now overlook silver's signal. Dollar dominance wanes as reserves diversify. Cold reality settles. This process advances midway through stage 4. No reversal, the mechanism runs. Silver's fracture previews broader unwind. Holdings in debasing fiat participate in the transfer. The next decade diverges from the last 3. Debts unpayable, debasement accelerates, elites positioned. Recognition arrives late for most. The pattern endures. Spot silver trades at $67.14 per ounce on the screens, but physical dealers quote $82 and up for immediate kilo bars, with queues stretching 8 weeks out. That's a 22% premium gap, the widest since records began tracking retail disconnects, and it's expanding weekly. On December 11th, the CME raised maintenance margins on silver futures by 10%, pushing initial requirements north of $20,000 per contract in a bid to cool the surge that peaked at $67.45 just days prior. Yet volumes exploded higher the next session, shorts covering another 15,000 contracts as unrealized losses topped $2 billion across the top 8 banks. This isn't volatility management. It's the control apparatus buckling, laid bare in daylight. Institutions like JPMorgan, long accused of capping prices through concentrated shorts, quietly closed their entire 200 million ounce paper short between June and October, flipping to a net long backed by 750 million ounces in registered vaults. The largest physical hoard in history. Trace the rupture further, and the signals align across continents. In a functioning market, paper claims settle into physical without friction. Premiums stay under 5%, inventories replenish seasonally, delivery notices flow routinely. But now, COMEX registered stocks hover below 80 million ounces after record Q4 withdrawals, while eligible vaults reclassify metal just to meet stands. Shanghai Futures Exchange warehouses logged inflows spiking to 780 tons by mid-December. Yet local premiums hit 18% over global spot as refineries run at 55% capacity converting imported ore. India's imports cleared 2,200 tons year-to-date, vacuuming Western supply chains dry faster than Peruvian or Mexican mines can offset. This split isn't transient demand. It's the monetary overlay fracturing. The dollar's post-1971 fiat scaffold, exposing its limits as physical reasserts dominance. Mirror this against the cycle's prior turns, where the breakage always emerges in the tangible first. Britain's pound held sway until mid-19th century industrial divergence drained reserves. Financiers rotated to U.S. assets while London pretended equilibrium. Weimar's mark collapsed under deliberate printing, but American credits arrived post-hyperinflation, restructuring before the next phase. Bretton Woods unraveled when foreign redemptions, France's warship, Britain's $3 billion call, outstripped Fort Knox's 10,000 remaining tons, forcing Nixon's temporary gold window closure that endures. Each time, the architects pivoted early. Paper debasement masked by suppression until physical scarcity forced revelation. Silver's role? The canary. Demonetized in 1965 to stretch dollar claims, capped for decades to hide inflation's creep. Now, with the dollar down 98% against gold since 1971, silver's 127% 2025 surge from $29 to $67 exposes the same overextension. The numbers indict without mercy. Global mine supply flat at 830 million ounces for 2025, down marginally as byproduct constraints bind. Demand hits 1.2 billion ounces again, per Silver Institute. Industrial alone at record 665 million, despite thrifting. Solar consuming 250 million projected for 2026. Cumulative deficit since 2021. 820 million ounces drawn from above-ground stocks. ETFs absorbed 113 million ounces, net inflows, YTD, SLV alone, locking 500 million off-market. Yet paper open interest lingers at 200,000 contracts, implying 1 billion ounces claimed against dwindling deliverable. Backwardation deepened. December contracts premium 8% over March. Holders demanding immediate metal, no futures discount can lure away. If you've navigated physical sourcing this year or tracked vault reports, describe the tightness you're witnessing in comments. Does the eastward pull feel irreversible from your vantage? Geopolitics threads through like ore veins. U.S. critical minerals designation for silver sparked pre-tariff front-running, draining London vaults by a third since 2022, despite recent 54 million ounce inflows. Russia's export curbs shaved another 40 million ounces, citing strategic needs. China's data center and EV buildout, silver-intensive conductivity, hordes via Shanghai, premiums there sustaining double digits, military drawdown accelerates, hypersonics and electronics guzzle 50 million annually. Pentagon inventories reportedly halved since 2022. Invert the sequence for clarity. Premiums preceded margin hikes. Physical lockups predated public deficit revisions. Cause flips to effect. Decades of sub-economic prices, starved capex, peaking supply just as green tech demand exploded 35% year-to-date. Suppression bred the scarcity, now inverting leverage. In 1980, Hunt's Corner forced rule changes. Margins spiked, exchange limits imposed. 2025 echoes, but deficit prevents reset. CME's 10% hike failed to liquidate longs meaningfully. Volumes rebounding as physical buyers unmoved. 1 ounce stays 1. Multiplied paper claims falter on delivery. What parallels ring clearest to you in these intervention failures? Weimar's press or Nixon's shock? Share your read in comments, particularly if modeling cross-asset implications. Behavioral cues from majors seal the pivot. JPMorgan's flip, closing 200 million short, amassing 750 million long, mirrors Rothschild's funding U.S. rails as Britain waned. Remaining banks like HSBC bleed on lingering exposure. CFTC commitments showing hedge funds slashing shorts 40% since summer. Miners re-rate lags. Equities up 80% versus metals 127%. Margins at Pan American topping 70% at $65 spot. Cascade widens. Logistics choke. Red Sea reroutes add 25% freight. Bottlenecking door to refineries. Recycling flatlines as high prices discourage scrap flow paradoxically. Finance overlays. Silver volatility index at 50. Triple golds. Fracture metric. Crypto bleed aligns. Bitcoin dips on contract rolls as margin cross calls hit. Broader unwind previews in petrodollar cracks. Saudi's 2024 agreement non-renewal. WAN oil trades up 400%. If cross-market drains match your observations in energy or basis, flag them in comments to connect the threads. The inexorability lies in debt mechanics. U.S. obligations, $36 trillion. Interest eclipsing $1.2 trillion yearly. Fed balance, $7 trillion still. Deficits, $2 trillion routine. M2, expanded 28% since 2020 against 16% GDP. Gap inflates claims, but silver's materiality resists. Stage 3 rifts visible. Physical paper divorce. Stage 4 underway. Institutions to hard assets, flows east. Non-linear exposure sharpens. Investment consequences manifest before full monetary causes surface. Wall Street's China integration amid trade theater. 1.4 trillion 2018 to 2020. Prototype this material shift. Populations missed prior transfers. British to America, German hyperinflation enabling U.S. restructure. Today, silver's alarm blares while discourse fixates decoupling debates. The mechanism advances, 3 quarters complete. No interruption in recorded history. Debts compound, debasement proceeds, architects secured. Physical holders retain scarcity. Paper participants fund the rotation. The coming years diverge sharply from the prior 3 decades. Unpayable liabilities accelerate erosion. Tangible reclaims pricing power. Recognition lags for most. The pattern persists regardless.